No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking about how to protect yourself in these volatile times. Here we are, the first month of 2016, and the markets are down about 7% year to date. Now, to put that in context, and for if this is making you nervous, okay, seeing what's going on with the stock market, this is a great time to take a look at your current situation, your current portfolio, for instance. What is your saving plans? What's your investment plan? You know, have you got a plan, in fact, even in place, or is it just, I'm hoping things are going to work out, all right? Or I call my, you know, what's that old saw, if you will, just stay tight, don't worry, it'll come back. Well, you know, sometimes not all mutual funds come back. Not all investments are able to rebound. And let's just say that we look at the broader market, though. The S&P 500 index as an example. This is the 500 largest companies in the United States. They make up 70% of the money that's in the stock market, okay? So these are the big companies, and yes, when you look at the S&P 500 index, if you had all your money invested, say, in that index, those 500 companies, would that in fact come back? Absolutely. Okay, you're not going to lose all your money in the S&P 500 index, but let's take a look. How long might that take? If you look at the market from 2000 through 2002, the bear market of that period, it dropped about 44%. The S&P 500 index, the market as a whole. All right, so dropped 44%, took 5 years to recover. Then we look at 2008. The actual period of that bear market was from October of 07 through March of 09. The market in total dropped about 55%. Okay, that 1 year in 08 was about a 38% loss. Now think of that again. How long did it take to recover? Again, it was over 4 years before you recovered, meaning that when you, at the beginning of that period to the time that you were back at a break even to where you started, took 4 years to accomplish, okay? So 4 years after the bear market. So you went from this to down for 5 years to where you were back to where you started. So again, do you have 5 years that you can sit watching, waiting for your money to come back? And the answer is, of course, if you're invested and you're in your 20s, 30s, maybe even 40s, yes, and you've got the tolerance to lose 40 to 50% of your money and sit tight and not make a change, and very important, you are invested in, say, the S&P 500 index. Maybe you have an S&P 500 index fund. Maybe you've blended that with an aggregate, a Barclays Aggregate Bond Index fund. Those two together, when you're first starting out, as long as you've got the stomach for it, all right, can give you a good return, all right, relative to the market. That's going to give you that market type return over the long term, all right? But again, it's the long term. If you're at or near retirement, okay, now this is for you that are, if you're within 5 years of retiring, okay, 5 years, and within 5 years I'm going to retire, or I've just retired in the last 5 years. Volatility is in particular a very big concern for you. If you've been in retirement for a while and you're starting to, you know, and you're using money from your savings, maybe from your retirement accounts to help supplement your income, this is especially important in terms of what this volatility means. All right, so let's look at that again. The market is down about 7% year to date. And if we look from 2000 through 2015, the average return of the S&P 500 index is about 3.8% a year. Okay, less than 4% a year. And we've, at that 3.8, and we lost 7% in 1 month, that's like losing 2 years worth of returns, isn't it? Okay, not real good in 1 month's time. What does the rest of this year look like? It's an election year. We've got a lot of volatility in the market. It's the worst start in the history of the stock market. So what do you think the likelihood, or the statistical probability, let's say, is it going to go down? We're going to have a down year or an up year? We're overdue for a bear market. Is this that year? Or maybe is it not just 1 year, but might it be a 2 or 3 year period? You know, in the 80s and 90s, we had the two best back-to-back decades in the history of the stock market. And a lot of us back then, in the 90s, I recall with clients that we were putting together portfolios, and based on what we did in the 80s and the way things were going in the 90s, we were thinking 10 to 12% was kind of like, you know, yeah, we can do that. But then what did we find from 2000 on? From 2000 through 2009, the first decade of this century, we actually had a negative return. And when you adjust for inflation, lost money, purchasing power, right? Now, these are the things that are important to understand when it comes to and why planning is so important. This isn't like a hope and a prayer kind of thing, you know. There's an old cowboy prayer. It's trust in God, but tie up your horse, right? You got to do your part. Don't just trust that things are going to work out if you haven't taken the time to make sure that your asset allocation on your current portfolio is correct, is done well. Okay? That you look really closely at your mutual funds. Do you know what's in those funds? Do you know how many stocks they have? Do you understand how these things work and how important it is for you to understand this stuff? So I'm going to make it easy for the first 10 callers to my office this morning. Okay? We're going to offer up a retirement income analysis. And that's one of the things I do is I dig deep into your portfolio, and I'm going to show you exactly how many stocks you have, what the turnover ratio, how often are those bought and sold within your portfolio or within your mutual fund. If you've got bonds in your mutual funds, most people do, of course, I'm going to show you what those bonds look like. If I'm going to show you, I meet with people every week, and whenever we look at bond mutual funds, I got to tell you, I would say on average at least 50% of the bonds held are junk bonds, and people didn't know that. That means very low investment grade is like a triple B or above. All right, triple B is kind of like right in the edge there. A's are the best. That's your investment grade. You get into the double B's and below, and some even C's, and some that are not even rated. They're seeking. These money managers are seeking, and these are the money managers, right? The guys that are in charge there at the mutual fund. They're seeking higher returns on these bond funds, and so they're taking higher risk by buying lower quality paper. Okay, or loaning those companies money that have very poor credit ratings. And their thinking is that when the market starts to turn, they'll be able to dump them. Problem is everybody is thinking the same thing. As Carl Icahn said, you got a big room full of people and a very small door they're going to try to get out, and a lot of people are going to lose money. Now here's another thing to consider when you're looking at the bonds, and that's the yield, okay, or not the yield, but the duration. All right, because it's seeking yield, seeking those higher returns. What they're doing is they're taking also not just low quality, but in many instances they're also looking at longer terms. So they're getting you into 15, 20, 30, 40-year bonds where you're locked into a particular interest, right? Because that's all a bond is. You've loaned that company or that government entity your money for this specified period of time, 20, 30, 40 years. Now you can sell that on the market, right? But if interest rates, as they are now starting to go up, and the Fed has indicated they're going to continue that policy, then that means bond prices, right, go down. Who's going to buy your bond that's paying 3% if they can go out and get a new bond that's paying 4% on these longer term bonds? So the only way you'd be able to sell your bond is if you reduced it down, discounted it, took a loss. So this is another thing. Do you even know what's in your portfolio? Well, if you take advantage of my offer, for the first 10 callers again to my office, 615-376-5325, I will be able to show you that. In writing, we'll pull the reports from Morningstar, show you exactly what's in your portfolio, help you, in fact, answer all the questions about retirement. Can I retire? Will I run out of money? When's the best time to take Social Security? You know, survivor benefits on pensions. If you're going to have a pension, should I take a survivor benefit? When do I take that? What are the advantages there? And also, so when you call my office, we'll send you out a packet of things to bring to the appointment with me to get the most out of it so we can do this analysis for you. And I'll also send you a copy of my book, 7 Steps to Financial Freedom in Retirement. And basically in the first few chapters we lay out a big part of the analysis, and in the latter chapters I talk about we go really in depth with this. I want you to get the most out of it. All right. I'm going to cover some things today. I'm going to talk to you about not only the negative parts about the market, but I want to really understand how this works, what it means, and most importantly, how then some strategies on how you can improve it for yourself, how to get 2 to 3 times what the average investor gets. We're going to make you above average today, all right? So join us here. We're going to be right back on the Retirement Report.